My name is Trenton Rhodes,
I'm Andres Arredondo.
and we did Ford versus GM for our analysis. So here are the top Ford shareholders, the top 10 mutual fund holders, and the top 10 owners. Vanguard Group, number one for both ones.
And for GM, we had Vanguard up at the top, and then Capital Research and Management for the top owners.
So why do they care about the cost of capital? The cost of capital is very important to investors because it has the potential to maximize the value of a company if done correctly. If the company can achieve this, then the investors are all much better off and the risk is minimized. These are some factors that help with it too, have an influence. So what is our cost of debt financing for Ford? So basically we found this by adding the default spread to the risk-free rate. So 1.27 plus the 2.68 came out to 3.95 for the pre-tax, and after tax is that times the 1 minus the tax rate. So that came out to 3.35% for Ford.
And for GM, we calculated obviously the same way. We ended up with a 3.92%. We also had a rating of Baa2. And then for our after-tax cost of debt, we came out with a 3.85% with a 17.4% tax rate.
So what is our cost of equity financing? So basically we took the 2.68%, the market premium, added it to the beta times the cost of equity. Came out to 7.07% for Ford.
And if we look at GM, we calculated the same way. We ended up with a 11.63% cost of equity.
What is our overall cost of capital? So for Ford, the debt ratio was 0.81, the equity ratio 0.189, the cost of debt was 3.35% as previously stated, and the equity was 7.07. So after all, the WACC comes out to 4.07%.
And also, as in the previous slides, we had a cost of debt of 3.92%, the cost of equity 11.63%. Debt ratio was 48.73%, the equity ratio of 51.27%. And then our WACC ended up coming out to about 6.49%.
So could we lower this by changing our capital structure? So Ford, the debt ratio is much too high. So according to the results, they must bring it down to around 20% if they want to be optimal. And after tax cost of debt would be brought down by 0.15%, which would bring the company's optimal WACC down to 4.04% and bring their enterprise value up to 100 billion to 558 million.
And for GM, this actually would not lower anything for us. It would actually increase our costs. Our overall WACC would end up about 0.06% higher. It would actually decrease the value of our enterprise by 955 million. We're going from the current ratio to the supposed optimal at 20%.
So how would a financial restructuring affect the value of the company? As previously stated, it would bring the debt to equity down to 20%. The net gain would be about $278 million. The cost of equity would drop to 4.3%, and the per share for Ford would go up to $8.53 per share.
And for GM, we could potentially reduce the debt ratio 28.73%. However, we did say that this would decrease our overall enterprise price by 955 million, as well as decreasing our overall stock price at 0.68.
So would more debt create a necessary risk? For Ford, yes, it would. Their debt is already pretty high. An increase in debt would just be unnecessary and put them in a bad position.
And for GM, our debt ratio is actually pretty optimal for where we are at right now, as well as the market value. So the optimal debt ratio being at 20% really doesn't seem like it would be necessary for them to decrease or increase at this point, and just stick it out where it is. I think that's it.
Well, what does the competition do? So this is just a quick little analysis of the competitors, like debt to equity ratios and their current ratios. So is our stock price fairly valued for Ford? At 846 right now, it's going to go up to 853 optimal. So I think right now it's slightly undervalued, and I expect it to go up in the future.
And for GM, according to the analysis, our stock value should be at 39.27 per share. However, right now it's at 39.95, and it seems that that is a better price for them to stay at without adjusting anything. Thank you.
Thank you.